Today we're going to talk about buying a house with an unmarried partner. My name is Tony Cameron with TLDR Accounting, and we provide tax and accounting services to small business owners and therapists in private practice. So, buying a house. Buying a house is a very stressful situation, and maybe you decide to buy a property with an unmarried partner. That could be a romantic partner. It could be your best friend that you're going to move in together. Maybe it's a sibling. Doesn't matter. As long as you're not married filing jointly on your tax return, or married filing separately, or married in any way, this would apply. There are several things you need to be thinking about. So with buying a property with an unmarried partner, are both of you going to be on the deed? Are both of you going to be on the mortgage if a mortgage is involved? Our recommendation is no matter what, you get a lawyer involved. You get an agreement set up about are you going to own the property 50-50? Are you going to own the property 75-50? And how is the payment of the mortgage, if there is a mortgage on the property, going to be paid? Who's going to be in charge of paying what? One of the things we've seen sometimes in the past is maybe if only one person's on the mortgage and the other person's not. If things go sour, the person who's on the mortgage and on the deed is the one who actually owns the property. And at that point, if there's a separation, you're going to have to get a lawyer involved anyway. So making sure you look at all these situations beforehand and making sure all your I's are dotted and all your T's are crossed is important. So there are a couple different ways to hold the property. You can have joint tenancy or tenancy in common. If you're not doing a sole owner, which we don't recommend. By the way, we are not lawyers. We are looking at this from a tax perspective, because one of the things that comes up is if you own a property with an unmarried partner, we want to know who's getting the tax deductions, right? That's what we really care about, because there's two different tax deductions associated with owning a property if you're doing rented out. The mortgage interest deduction and then the property tax deduction, right? Those are two big deductions on Schedule A, and we need to know, are you splitting it 50-50? Are you splitting it 25-75? Is only one of you claiming it? Because if your mortgage interest and your property taxes are below the standard deduction, after you split them, then you're both just getting the standard deduction. But if one of you took them and it was over the $12,400 for the standard deduction, then there's a tax benefit for having that house. And so making sure that you know this and you have it documented and you agree on who's going to take these deductions in what years is important, right? We want to maximize your tax savings if possible. I highly recommend that you do take, a hard look at this before you buy a property with a partner. Just make sure that you do get a legal document in place so you're both protected in case of a separation or, God forbid, a death in the one of you passes away. With COVID, a lot of weird stuff has happened. But yeah, so that would be our considerations. Make sure you get a lawyer involved. You figure out who would own what if something does happen to one of you, or if you decide to terminate the relationship, how would the house be divided? Would a buyout need to happen? Are you going to sell the property and then you just split the proceeds according to your ownership percentage? So as you can see, documentation would be key here. And part of that is make sure you just decide what's going to happen with the tax deductions, because that's what we want to know about. Hopefully you found this helpful. If so, subscribe below.